Welcome, everyone. My name is Andrew Paolillo. I am the Director of Member Strategies and Solutions here at the bank. And thank you for joining us as we present some ideas today in a new and a little different format that hopefully you will find useful. Today, we'll be looking at a case study on how to take advantage of a flat or inverted yield curve. So the background here is that the front end of the yield curve, specifically inside of 1 to 2 years, has flattened and in some tenors inverted. That presents a situation for members as they assess where they need and want to be from a funding perspective to accomplish a couple of different goals all at the same time. What we will show today is that there's some relative value in a moderate extension up the curve, which can lead to reducing funding costs from day one, mitigating interest rate risk, and reducing the repricing risk that comes with rolling short borrowings, while at the same time not giving up much of the potential benefits of that type of strategy. At this point, the beginning of 2020 may seem like more than just a few months ago, but lost in the post-pandemic environment that we're in is that the front end of the yield curve had inverted well before the crisis escalated here in the US. After the 150 basis points of emergency rate cuts in March created some steepness in the yield curve, albeit at lower nominal rates than we're used to, with 0 and 1% handles, that slope has slowly drifted away back towards inversion caused by 1-year rates moving lower and lower, while short-term 3-month rates have remained relatively constant. When looking at the advance curve relative to Treasury rates, we can see that the shape of the two curves differ slightly. While Treasuries have a small amount of positive slope from 1 month to 2 years, with advances, the curve is actually inverted out to 1 year and steepens after that. Much like on decisions regarding deploying assets, the spread to the benchmark rate at any particular term for the liability can play a significant role in telling you where the best value is. With the current advance curve, spreads are narrowest in that 12 to 15-month range. Monitoring spread levels is an important task because while FHLB advance rates have shown to be extremely stable and at low spreads versus treasuries, they do change. Often that band is very narrow, normally plus or minus 5 basis points versus the average spread level of 29 basis points going back to the beginning of 2019 when looking at the 3-month term. But in periods of high volatility, much like we saw back in March of 2020, they can occasionally move much more than that. While the shifts paled in comparison to the more extreme moves that were seen in many other instruments, asset or liability, that our members typically use, it underscores the importance of spreads and repricing frequency in balance sheet management. So what we want to do now is compare a strategy of taking a 1-year advance today, when the curve is inverted, versus a strategy of rolling 3-month advances for that same 12-month period. By running a couple of different scenarios, we can see a range of outcomes and what the opportunities, risks, and trade-offs are. Here, when looking at break-even rates, and by that we mean what rate does the succeeding 3-month rates need in order for the rolling strategy to, quote-unquote, catch up to the fact that on day one, you're paying a lower rate on the 1-year advance. So with the original 6 basis points difference, that's 36 basis points for the 1 year on day one versus 42 basis points for the 3-month, that means when it comes to the beginning of month 4 and it's time to roll the 3-month advance, the rate over the next 9 months would need to be 34 basis points in order to match the 36 basis point cost of the original 1-year advance. If we were to assume that the 3-month rate is unchanged and stays at the current levels, at each quarterly rollover, the rate needed for the remaining time frame would need to be lower. When there's 6 months to go, the rate would need to average 30 basis points for those final 2 quarters. And when there's only 3 months left, the break-even rate drops even further to 18 basis points. So the unchanged scenario is favorable, but now we want to perform a stress test to see what happens if you undertake the extension strategy, but conditions move against you. We'll also look at a more favorable set of conditions, and what we see is that the profile is asymmetrical, but in a good way. The magnitude of the positive case will exceed that of the negative scenario. So here in stress test number 1, we assume that after taking the advance on day 1, either the 1-year borrowing or the first of the 3-month block, we see that T-bill, we're going to assume that T-bill rates, which drives where short-term classic rates are priced, T-bill rates go to 0% And on top of that, advance spreads versus treasuries also tightened by 5 basis points. In this scenario, the 3-month classic rate would go down to 24 basis points. And the member who rolled that for 3 more quarters would have produced an average rate over the 12-month horizon of 29 basis points, bettering the 36 basis points from the initial 1-year rate. In this instantaneous and persistent rate shock, and remember, it's a stress test, so we should be okay with a more extreme and rigorous review, the strategy underperformed by 7 basis points. Test number 2 looks at something similar, but probably a little more realistic. T-bill rates again go to 0%, but given what that type of flight to quality move typically signals, and producing some volatility in the credit and funding markets, we assume that short-term advance spreads will widen out by 5 basis points, mitigating some of that T-bill move to 0%. As such, the new 3-month rate goes only to 34 basis points, and we see that produces an average rate over the horizon for both strategies that is equivalent. To reiterate a point from earlier, this shows how there can be value in locking in the tighter and lower and longer spread in the 1 year, such that rates moving lower do not necessarily always favor the rolling short approach. In contrast to number 1 and 2, test number 3 will show the potential upside of the strategy. We know intuitively that rising rates would cause a rolling strategy to underperform, but given the signals in the market and from the Fed, something like an up 100 basis points parallel shock wouldn't necessarily be of much practical value today. So what we did is look to the second quarter of 2020, when rates were quote-unquote pinned to 0, T-bill rates did drift up to a high of 28 basis points on the heels of ramped-up stimulus funding-related issuance, and advance spreads were also a little wider than current levels. So if we saw where 3-month advance rates might be in that scenario, we get a rate of 64 basis points. The rolling strategy would see its average cost go up sharply, all the way to 59 basis points over the 12-month period, which is 23 basis points more than the original locked-in 12-month funding at 36 basis points. So to wrap things up, the inverted and flat yield curve presents some interesting opportunities. And when we run scenarios on how it may stack up versus an alternative approach, we see something that every balance sheet manager is consistently in search of, an upside case that exceeds the potential downside. In a very rigorous stress test, the interest cost is only slightly higher. In an unchanged scenario, the interest expense is slightly lower. And if short-term rates drift towards the high end of the recent range, then the cost savings could be substantial. I'll point out that the break-even hurdles and the stress test results are only further aided when improving the rate by leveraging things like the advance renewal discount program or taking advantage of any special advance offerings. For example, in some recent instances, we've seen the break-evens for the later period 3-month rates get below 5 basis points, or more than 35 basis points below current levels. And while today we looked at the 1-year term, we've run some scenarios where using terms out to 15, 18, or even 24 months, and as the curve shifts around, a lot of this favorable risk-reward profile holds true in these instances as well. Thank you for your time today. Hopefully this was of value to you. If you have any questions or would like to tailor any of this analysis to a strategy that you may be contemplating, please do not hesitate to reach out to myself, the money desk, or your relationship manager. We'd be happy to assist however we can. Thanks again, and have a great day.